The checkbook control self-directed IRA is probably the most exciting development that's happened in the self-directed IRA world, in the last 20 or so years. I've actually written 2 books on the self-directed IRA checkbook control structure. It's something that pretty much since the 90s has become the most popular way for alternative asset real estate investors to make real estate investments with their retirement funds. And really the whole checkbook control structure was premised on the tax court case Swanson v. Commissioner. In this tax court case, the taxpayer established a entity that was wholly owned by the retirement account, and the IRA holder, Mr. Swanson, became the manager, president of the company, and then the IRA funds were contributed or invested into the entity, and then the entity made investments through it. The IRS got wind of it and kind of never saw this before, didn't know what to expect, and thought that it could be prohibited because they didn't know if the fact that the IRA holder was the manager could be problematic. It turns out that the tax court agreed with the taxpayer and said, no, a newly established entity wholly owned by an IRA and managed by the IRA owner is not a prohibited transaction. The entity only becomes disqualified once the IRA funds are in it. And then after that, of course, the regular prohibited transaction rules would apply in terms of what you can and cannot do. So the tax court agreed with the taxpayer. It actually imposed sanctions on the IRS for continue to pursue that line of arguments with respect to the prohibited transaction argument for the entity. They weren't happy with the IRS's continued aggression on that side, and they sanctioned them for that. But since then, in 2001, the IRS came out with a field service advisory opinion, basically mirroring the facts in Swanson, to let all their agents know who are auditing these types of structures that this is our position. Then yes, a newly established entity can be wholly owned by a retirement account, managed by the retirement account holder, without triggering a prohibited transaction. So after that came to be, pretty much from the early 2000s, anyone that's looked to do alternative assets with a lot of transactions like real estate flipping, any buy and sell real estate opportunities have looked to the checkbook control. So the checkbook control in Swanson, they used a DISC company, which is basically a foreign service corporation, which isn't practical for most taxpayers if you don't do any exporting outside the United States. So the LLC, or limited liability company, became the vehicle of choice for pretty much everyone because of its pass-through tax nature. So unlike a C corporation, which is think of it as a big box. The C Corp pays tax on the income it generates. Now, thanks to President Trump, it's only 21%. The maximum rate, it used to be 35%. And then the corporation pays a tax, and then anything retained after the tax can be dividend back to the shareholders, and the shareholders would pay tax. Well, we know IRAs don't pay tax. So with a C Corp, there'd be one level of tax, and the dividend to the IRA would go back to the IRA without tax. But there still would be that 21% tax. Whereas an LLC, think of it as like a triangle or like just a funnel, where the income funnels through to the owner. There's no entity level tax like a C Corp. So if the LLC made $100, the LLC would not pay any federal income tax, and the owner would pay tax on the $100. But the owner is an IRA, and we know IRAs don't pay tax on the income. So it becomes very tax efficient. You may be asking, well, what about the S Corp? S Corp is a C Corp that files an S election, pretty tax advantageous, treated as a partnership for tax purposes or a pass-through entity. Unfortunately, IRAs cannot be shareholders of an S Corp. A 401k technically can, but an IRA cannot. So that kind of removes the S Corp from the equation. So we got to focus on the LLC. LLCs have been common. All 50 states have LLC statutes. Pretty much since the early 80s, LLCs have become the vehicle of choice for most small businesses. I read somewhere, I think, that 95% of all new businesses are pass-through entities like LLCs. Obviously, the LLC is not a business. It's just a vehicle, special purpose vehicle, just being used by the IRA as a conduit to make the actual real estate or cryptocurrency investment, for example. So it's very tax efficient because it doesn't pay tax. So it gives you a limited liability protection, right? Like a C Corp, a limited liability, as the name states, means that if, based off state law, is anything outside of that LLC is protected from creditors. So if your LLC has $100,000 and there's a house in it, the fire, God forbid, it kills 20 people, you don't have enough insurance in that LLC to cover it, the creditors can't go after you or your IRA as the owner. They can only attack what's inside the LLC or the corporation, which is another layer of protection, another favorable trait of the LLC, and another reason why the LLC is very popular for businesses and also as a pass-through vehicle for IRAs. So we have your IRA up here. We have the LLC. Think of it like a triangle underneath it, and then you have your investment underneath it. So you have the IRA, the LLC, and the investment. And basically, the money gets, step one, you'll roll your IRA or 401k tax-free to the IRA custodian. Step two, the IRA custodian will then wire the money to the LLC. The LLC could open a bank account at a local bank, credit union. That you'll, as the manager of the LLC, generally you would want to be the manager, someone who has control, because if you put third party as the manager of the LLC, they have literally check writing over the LLC, so they could write a check to themselves and take all your money. So generally the IRA holder or a spouse or a family member would be the manager. Again, Swanson's clear that it's not a privileged transaction. And then once the LLC has the cash, after the custodian wired the money to the LLC or sent the check, there, as the manager of the LLC, you can write a check or a wire and buy the real estate. Title will be in the name of the LLC. You can buy cryptocurrencies, link the account with a Coinbase type exchange, buy precious metals, tax liens, promissory notes, hard money, loans, whatever you want to do that's allowed. And we know from reading the tax code under its Internal Revenue Code section 408 and 4975, there's three things you can't do. Okay, you can't buy life insurance, can't buy collectibles, and you can't do a self-dealing transaction, which under 4975 is any transaction that directly or indirectly personally benefits you or a lineal descendant. So you can't buy a house and live in it. You can't take your IRA money and lend it to your parents, or can't take your IRA and pay off your mortgage. The IRA investment can only benefit your IRA. So you can buy a house and rent it to a third party. Even brothers and sisters are okay. You can take your IRA and lend it to your brother or sister. So you got a lot of great things you can do. The LLC is just another way of doing it. It gives you a little bit more control, puts more of the action in your hands versus the custodian. If you don't use the LLC, you got to have the custodian do all the work, which is possible, and a lot of my clients do so. But there's some additional transaction fees, and there's some time delays because you need to fill out expense payment request forms and have the custodian do all the work. So you have the option. You can have the custodian do it, or you could set up the LLC. The advantage of the LLC is you got limited liability protection. You have more control, more ease. Everything happens through the checkbook or wiring. And over a long period of time, the costs are reduced because the custodian fees are a lot less than the custodian-controlled approach, where the custodian is more involved, where you have to go through the custodian to get things done. With checkbook control, you simply write a check to get it done. Lowers your fees dramatically. Yes, the disadvantages, there is the upfront cost. You need to set up the LLC or have someone do it for you. So you got to budget that in. But if you keep the IRA open 3, 4, 5 years, because of the reduced custodian fees from year to year, you'll end up being way ahead. Overall, I'd say 70% or so of my clients use the checkbook control, especially if you're doing real estate, and 100% for cryptos. It's really the only way to do it. And it's really gives you a lot of control, reduces your fees, and I think makes your life a little bit easier. Single member LLC has no federal tax reporting requirements. There is annual fees depending on the state. Most states it's very minimal. California does have an $800 minimum franchise fee, so that's something to keep in mind. But most states it ranges from $0 to a couple $100. Majority of states do not have franchise fees. California, Tennessee does. The trend is to actually go away from it. Illinois used to have a really high annual filing fee and annual maintenance fee, and they've reduced that dramatically because it's been seen as anti-business. Some people are setting up entities outside the state, which isn't good for anyone. So basically, the LLC is very affordable, especially once everything's been set up. Generally, there's very little tax filing requirements because a single member LLC treated as a disregarded entity. There's no tax return. If the LLC is owned by 2 IRAs, like a traditional or Roth, there could be a partnership return requirement, a Form 1065, also a state partnership return requirement. So that's something to consider, whether you want to stay with single member LLCs or do a partnership and commingle traditional and Roth in one deal, or an IRA from multiple people. It's your call. If you do multiple IRAs that own the LLC, you got to deal with partnership return, a 1065. It needs to be filed generally March 15th. But otherwise, You get limited liability protection. You have control. Fees are reduced. I think you're going to have a little bit more control and certainly ease in investing, but there are upfront costs. I think the costs are a lot more appealing over a long period of time. You'll actually be ahead because of the annual fees are much lower from year to year versus a custodian approach without the LLC. But again, it's up to you. There's no right or wrong way of doing a self-directed IRA investment. It's totally up to you. Either way works. You just got to figure out if you like the LLC, you want to control through a local bank account, or you don't. Again, I've written 2 books on the self-directed IRA, Checkbook IRA. So there's a lot of information. And obviously, you can find more about it selfdirectedira.org. There's some great information on the checkbook control or the custodian controlled IRA. My advice, if you're interested, is if you're doing a lot of transactions like flipping or definitely cryptocurrency, checkbook control is probably a good option. If you're going to do holding of land or private equity, precious metals, private business, private placements, you can look at the custodian control because you may not need the checkbook control. Otherwise, you have some great options. Do your research, see what works for you. But the checkbook control could be a really valuable tool for you.